Welcome back. Well, as promised, let's get to our first management on the show. Syrma SGS, we have with us Mr. Gujral, the MD at the company, who joins us. Hi, Mr. Gujral. Good morning. Good to see you. Well, on the top line, it appears a little bit softish, but your margins were a pleasant surprise. For the coming year, that's FY26, do you stick to the revenue growth of around 30 to 35%? And do you want to up the margin guidance of around 7.5% post the last quarter showing? So give us both those two numbers, revenue growth, margins, and what will exports come in at? It fell short a little bit of in comparison to the 1,000 crores that you had guided earlier.
Yes. So if you recall, when we had the earlier earning calls for the quarters, I had always advised and suggested that we should be looking the company for a year as a whole and not quarter on quarter. So the 12-point odd senior upwards of 12% EBITDA margin in Q4 is essentially driven by the product mix, where
Correct.
my industrial and healthcare accounted for almost 50% of my revenues. And these are margin accretive segments. We had guided that we would bring down the low margin consumer business to 35% of our revenue from 40% last year. We have achieved that. Going forward, we believe that for the coming year, we would be able to do a revenue growth of about 30 to 35%,
Okay.
which would primarily be driven by the product mix. If my high margin businesses go up, the revenue growth could be slightly lower, but it will be margin accretive. We had guided for a EBITDA margin of 7 on a blended thing for a year as a whole. We have delivered 8 point something. On a conservative basis, I would guide 8% EBITDA for next year, which in rupee terms would come to about 400 odd crores.
400 crores. Just one more thing, sir. What about exports as a percentage of your mix?
Exports this year we were targeting, and I had shared with the street that we would be crossing the 1,000 crore marks, but they have been muted. We have almost been there where we are, though for a 4-year CAGR, we have grown at 15%. I expect to cross that milestone, which we should have crossed in FY25, in FY26.
So 1,000 crores in exports, that target remains.
Yeah,
Mr. Gujral, okay, got that. So Mr. Gujral, sir, for this year, FY26, you're saying that top line growth should be in the region of 30 to 35%, margin guidance of 8%. Let's talk about this product mix as it's changing, because you're bringing down the share of the consumer business. So what will drive the growth? I mean, how quickly can the industrial segment ramp up? What is the growth that you see ahead for industrials? Because that's your high margin business, right?
Yeah.
What kind of companies, so what kind of companies, what kind of contracts are you looking out for? And will, industrials, will that be driven more by local contracts and domestic growth, or will you focus on exports here as well?
Industrial would be driven both by local and exports. And in the domestic market, the key driver will be the smart metering business. Last year, we did almost like 4 million pieces of smart metering electronics. So growth in exports would primarily be driven by industrial and healthcare. Automotive exports are almost very minimal. So the growth in the coming year will be driven by the customers which we have onboarded and started commercial supplies in later part of this year. So I get a full 12 months in FY26 against maybe 7, 5, 6 months in FY25.
Right.
So can you just give that really helps, because your focus segments, very clearly as you're saying, are industrials and healthcare. So for these two businesses, what will be the run rate? Do you think you can grow revenue here about 20%, 25%? What would your target be for your teams for these two businesses, which are your focus areas?
So when I say that I would be growing my revenue at about 30, 35%, consumer, I'm saying I'll bring it down. I'll try to maintain it at 35 or try to bring it down. So obviously, if consumer remains stagnant, which accounts for about 35% of my revenue, so the growth will be driven by the 65%.
Yeah.
And in this 65% is the automotive, industrial, and healthcare.
Yeah.
Apart from little bit of railways and IT.
Mr. Gujral,
segments would drive the growth. Automotive, healthcare, and industrial.
Yeah. Just a couple of questions, Mr. Gujral. For industrials, you said it's smart meters, right? is the major product which drives
For
growth?
domestic. For domestic.
For domestic. So this is largely driven by the government sector, correct? I mean,
Yeah,
or this
we
is
don't supply to the government, we supply to the metering companies. But yes, the end
the
consumer
program
is
is
the
driven
government.
by. That is all set, right? I mean, there is, for example, in Bombay, I can tell you, there is a lot of, in many parts of the city, there is a lot of opposition to smart metering. You know, big housing complexes, etc., written to the BMC here, opposing these meters to be. There is a lot of, I mean, you know, it's kind of back and forth. So, do you expect that to go smoothly since it's a growth driver for you?
Business with government, where the government is the end customer, is never a smooth ride. So let's be very honest about it.
Right.
But having said that, we have grown this year, and first 2 months also, the traction has been equally good. So I don't expect on a long-term basis a significant impact on this, and we believe this business would continue to grow at least for the next 2 to 3 years.
And this, you're making the meter itself?
No, we
Mr.
are
Gujral?
making the electronics for the meter.
The electronics for the meter, got that. And the second is healthcare. What exactly are you making there?
So in healthcare, we are making the RFIDs and the end products. End products for maybe neonatal respiration, heart monitoring, beauty products, laser products.
Yeah.
And there we have got a very good traction in design and services, which is very high margin accretive, and which results in long-term sustenance of the growth, because the product which I designed in 1 year, it will see production, commercial production in the coming 2-3 years.
Got it. All right. Got it. Mr. Gujral, very quickly, if you could tell us, you have taken an enabling resolution for a QIP. You intend to do it some part of this year?
Yeah, I think we had taken it last year, so that was expiring.
Yes.
We have taken it again this year.
But will you raise money, sir? Because you have barely any debt. So I was wondering why you're going by the equity route and not debt. What will it be used for?
Inorganic acquisition, which we keep evaluating in the sectors where we are not present, as I've already been saying.
Okay.
And now the component policy of the government of India has also come in.
Yes.
And we would be participating in that. We are evaluating that. And should we participate in a vertical which requires a capex higher than what my internal cash flows and other things can manage?
Yes.
That's why we have taken this enabling resolution.
So sometime...
Primarily driven at acquisition, inorganic acquisition.
And components.
And maybe something for the components if I find it that the funding requirement is more than what my internal cash flow generations are.
So you will raise money via the QIP route around 1,000 crores if both these two need to happen, inorganic growth?
Both or any one of them. So
QIP is something we look forward to. Very quickly, final number I'll ask you before we let you go. What is your current order book?
My order book is in line with the revenue generation projections, which I have shared with you, a 30-35% growth over current thing. So quantifying into the numbers, it will be 5,300 plus crores.
All right. Mr. Gujral, appreciate you joining in. We'll hold you to these numbers. The margin number is something that we'll hold you to, 8%, and I think 400 crores is what you said in terms of an EBITDA number for the coming year. And we'll watch out for that fundraise by the equity route as well.